Welcome to this edition of Business Redefined, your weekly most comprehensive look at the world of business and economics. Now, April 20th is just around the corner, and if you're a company whose financial year ended on December 31st, 2020, then you are supposed to be compliant with minimum tax, depending on whether that is applicable to you. And to make sense of this, we're joined by Samuel Mora, a partner at Grant Thornton. Welcome on set.
Thank you, Julians.
First of all, there are many players out there who are still asking, how do I know if I should be the one who's expected to be compliant with minimum tax or not? Just give us the background around who should be compliant with this.
Thank you once again. All taxpayers who have an income are supposed to actually pay minimum tax depending on the period, year end or period of their financial statements. Already we have some who paid in March, and majority of them whose year end is in December will be paying by 20th of this month. Minimum tax will be calculated based on the gross income, which is net of VAT. And it will be based on income generated from January to March for the December 2020 year-end companies. Now, there are also exclusions as to who will not be paying. So if you're in any business where the price is controlled by government, for instance, fuel, then you'll not be entitled to pay minimum tax. Those whose income is also subjected to capital gain tax will not be paying minimum tax. Any company, aviation industry, any aviation company whose government has invested more than 45%.
You mean KQ in that case?
KQ in that case and its subsidiary, because government actually owns 48.9%, will not be subjected to minimum tax. Again, there is insurance companies, and please note it is not the insurance brokers but the main insurance companies who will not be subjected, and definitely if you have employment income, you will not be subjected to that. In terms of rental income, if you are actually paying residential rental income tax, then again you will not be subjected. And for the rest, whether you are making a profit or not, you need to calculate to determine how much minimum tax you are paying and compare it with the installment and pay the highest of the two, the higher of the two. Yeah.
Let me walk you back to the insurance firms. Many of us are still not clear why particularly insurance firms are exempted. We understand why OMCs, oil market companies, retailers are exempted because their price is controlled. But insurance firms, just help us understand this.
Insurance firms are already paying 1% insurance levy to government, and that was their argument, and it was accepted by Parliament that they should not be charged another 1% in terms of minimum tax. So that was the basic reason as to why they were exempted.
If April 20th gets here and one who should be compliant fails to be compliant, what are the repercussions?
Section 83 of Tax Procedures Act is very clear. Anyone who fails to pay any form of tax, there's a penalty of 5% on the tax payable and interest of 1% per month until as and when they are going to pay the minimum tax applicable.
There are potential legal hurdles. We know there have been a number of voices seeking to have this idea of minimum tax shelved. Do you see this presenting a challenge to the implementation of minimum tax even as we start 2021?
From the time the Finance Act was enacted, Finance Act 2020, and introduced minimum tax, we were invited to submit our submission before minimum tax becomes effective in January 2021. A lot of stakeholders did submit their memoranda to Parliament for consideration, and most of us actually were of the opinion that it was not the right time to introduce minimum tax. But looking at the report of the Departmental Committee of Finance and Planning, it was clear the government had planned to collect 21 billion Kenya shillings from minimum tax. So all the submissions were thrown out of the window, if I may just say that. And I foresee a situation whereby the only way business people have is to have one of the bodies going into court, just like it happened with the Insurance Brokers Association last year when VAT was introduced on Insurance Commission. They went to court and a stay of the status quo was obtained. So VAT was not being charged on commission. So the only option we have is just a legal system.
Then the question becomes that do you see whether there's any wiggle room for us going forward to have a policy discussion around minimum tax? Because many have said, okay, fine, if you're telling us that minimum tax has to stay, particularly in light of IMF conditions, can we have a conversation around the rate from 1% maybe? Or that if I'm a loss-making company, I should have been loss-making for a number of years as a threshold before minimum tax then kicks in?
What I see is changes being made not on the rate, but probably to delete the section 15(4) of the Income Tax Act, which talks about giving us an allowance of 9 plus 1 years to carry forward our losses, because it contradicts section 12D, which introduced minimum tax, contradicts the need to us even having section 15(4) of the Income Tax Act. I do not see any chance of government reducing either the rate or to deleting section 12D. So I think minimum tax is here to stay. We just need to see how to navigate our businesses. This is going to have, of course, repercussion, and I don't think increasing prices of the products to cover the 1% will be a solution. But businesses are going to suffer. It will become, and unfortunately for loss-making companies, it is an added cost which has a tax implication because it becomes a sunk cost. You cannot take it as a business expense. So it will really affect a lot of businesses, and it will also going to stifle investment, because if I know I'm going to invest in the country and yet 1% on my sale, without even considering the provisions of section 15 and 16 of the Income Tax Act, where I'm allowed to deduct expenses and pay taxes based on my net income, then it's going to discourage a lot of investment into this country.
So Samuel, as far as the applicability is concerned, many businesses still ask me that for Q1 it makes sense. The quarter ends on March 31, I'm compliant by April 20th. But what about the second quarter? It's due for compliance by June 20. How does that work?
The payment of minimum tax is the same with the application or the payment of installment taxes, where the law is clear. Installment taxes should be paid 4 months after the end of any financial period. The second installment is paid on the 6th month, and that is what I think brings the confusion. The third installment is paid on the 9th month, and the fourth installment is paid on the 12th month. But the way the guidelines for minimum tax has been given is that first installment is straightforward, 3 months pay on the 4th month, and then the second installment in June, you only need to factor in the month of May, April and May, you pay it in June. And then the third installment in September, you'll have to factor in the month of June, July and August. And then the fourth installment, which is supposed to be to be paid in by 20th of December, you'll have to factor in September, October, November. Remember then, that means you'll have 1 month to pay. That is December. If we just give a simple example of a December ending company, then the guidelines gives you 4 months to pay minimum tax on the income you will have received for December. So that will be paid within the month between January and May of the following year.
I spoke to the Treasury about this issue of minimum tax, and I know previously we've had a conversation where you've raised questions around even its compliance with the canons of taxation. And they will tell you that we are really trying to weed out the tax cheats for those businesses who run their enterprise, but then they have multiple sets of books. One where they are currently reporting losses, and that's what they file with the authorities. But the genuine ones they never reveal, and therefore they are evading in a sense. Do you think that argument flies?
With the introduction of iTax, and this is where I think it's a milestone, I can say KRA was able to come up with. It is easy at the comfort of their desks to see that the sale that Julian's Limited did to Sam Limited has actually been accounted by Julians. Because what really used to happen, and this was a problem which necessitated the creation of what we call a project by KRA called VAA, VAT auto assessment, is that there are people who used to use buy invoices and use them to reduce their expenses. But with the introduction of iTax, that's no longer an avenue any businessman can do or can utilize to reduce the taxes they are paying. So in as much as that notion was there before, and I cannot deny it was there, it has really drastically been reduced by the fact that, one, iTax is now able to track the movement of transaction between a seller and a buyer to a seller, and also the introduction of minimum tax. So if you're trying to actually have a creative set of accounts in your business, then you'll still be caught with 1% of your gross income, which is very punitive in my opinion.
The last we had a conversation, the portal had not been updated to enable or facilitate compliance with minimum tax. Has it been by now?
Yes, it was, albeit late, and I think because the guidelines were also not very clear as to when the first installment should be paid. So the first iTax was actually enhanced on 18th of March 2021, and some taxpayers have actually paid their first installments by 20th of March 2021.
And that point by Samuel takes us to a short break. Business Redefined will be back with a lot more on this conversation now, focusing more broadly on the tax environment in Kenya. Stay tuned. Welcome back to Business Redefined. We're discussing the tax environment tonight, and we're privileged to have Samuel Moran, the partner at Grant Thornton. Welcome back on set.
Thank you so much.
You and I have seen the numbers thus far being tabled by Treasury and KRA as well, as far as the performance is concerned. KRA has gone as far as issuing a statement regarding the March performance. Quite impressive, I think, in their view. What are your thoughts in terms of their tax, I should say, outturn thus far?
It is interesting to know that when they outperform themselves or their expectation, they really inform everyone. They use all media of communication to let us know. But I hope this spirit will continue even when they underperform and give us a reason. What they need to actually relook is the parameters as to why they have actually performed more than they expected, despite the calamity and the question of effect of COVID on business. Please note that there has been a slight growth in terms of business and environment from January, when everyone went back to business and people tried their hand in literally all kind of activities that could generate income. And that could be attributed to the reason as to why tax collection has been high. Importation increased right from December coming through. But I do not expect the momentum to continue, and especially with the cessation in this particular zone, and the effect of more restrictions being put in different countries going forward. So it will still be a challenge. They will not achieve their target, and not in a bad way. They will not achieve their target.
Speaking about digital services tax, a lot of us were curious to understand how the transactions would be traceable, particularly if you consider the fact that a lot of payments could be happening in the mobile money space, and you can't really tell which is a P2P remittance versus which is actually payment for a transaction. 1 quarter into it, how do you think it's unfolding?
The initial idea globally about DST was to go for the multinationals who are actually not paying taxes, but they are doing big business. Kenya, we went ahead and also wanted to target the influencers, small fish, in my opinion, and yet they are big businesses who are doing offering digital service, using their platforms and not paying any form of taxes, and actually making money, for instance, from the Kenyan market, but shifting the profit back to their countries. Again, the initial idea KRA had is that at the point of payment, then there will be a withholding DST But then they realize there'll be a complication in terms of if today I'm enrolled, I have a subscription with Netflix, for instance, or I'm buying anything to Alibaba, unless I pay the full amount, then they are not going to release the product I'm asking. Netflix, which is not going to renew my subscription if I don't pay. Then they went back to the drawing board, and it is now a self-assessment regime, whereby the provider of the digital service using a digital platform determines how much income they have and deduct 1.5% and pay. And it is like, if it is a resident company, then it is an advanced tax. If it is a non-resident, for instance, Netflix, then it becomes a tax which will not be recovered by a non-resident company. So what will actually determine how much they'll collect is the level of compliance. And I think the only people who are willing to comply with DST are the already compliant companies which are operating.
Samuel, at the end of this month, we're expecting the finance bill. And there's a lot of anticipation as to what it could contain, particularly within the context of the budget policy statement, which, if you look at the revenue projections, many of us think it is quite ambitious going into the next financial year. What are some of your high-level expectations on the finance bill?
There's been discussion on social media about one of the recommendations by IMF that VAT on fuel should be increased to 16%. Of course, the grace period is coming to an end by end of June this year, the 3-year grace period we had in the VAT Act 2013. So that is one area they can look at, increase VAT of fuel from 8 to 16. And I'll not be surprised if there's an intention to match the VAT rate of Kenya with other East African countries. Burundi, Rwanda, Uganda, Tanzania, VAT rate is 18%. Kenya, we are still charging at 16%. That's another area they can look at. Excise duty might be introduced on more products, which has been the trend over the last few years. I don't see anything being done on corporation tax. We are classified as one of the countries in Africa with the highest VAT corporation tax rate. So I don't see them touching anything to that. And probably they still need to reduce more of the exemptions they are given if exemptions are not making sense and we as a country are not seeing benefit to it. So there is little room for the CS and Treasury to play around in terms of collecting more taxes from Kenyan taxpayers.
The VAT on petroleum products is likely to be a hot potato given the precedent we've seen. And just last month when EPRA did the monthly review of pump prices, the public uproar was massive. And there was so much discussion about where the fuel prices are heading. Do you really think there's room for that?
The government needs to realize that increase of taxes does not mean increase in revenue collection. You can increase VAT to 16% from 8%, but then expect consumption to go down. Then it negates the reason as to why you need to increase VAT. So there will always be a ripple effect on consumption. So it is not a solution to collection of more taxes.
Looking into the finance bill, a lot of industrialists I've spoken to are really worried about the trend they saw last year when the capital allowances were clawed back. And they're just wondering, what is the outlook like going into the next financial year?
I think the whole intention of revising the rates of investment allowances and introducing minimum tax is not really to increase a tax base in terms of numbers of taxpayers, but to increase the cash flow. Because you're giving me an allowance to encourage me to invest, again you're coming to charge me minimum tax. It really doesn't go well with taxpayers. So we took it, most of us as investors took it negatively.
And one of the things which of course has been a huge subject of discussion has been the voluntary declarations. I don't know from where you sit, how you see this being taken up by Kenyans?
This is another form of amnesty. And remember, we've had amnesty in 2002 When the Kibaki regime was there, we had another amnesty in 2015 on residential properties. That's how residential income tax was introduced. There was another foreign amnesty which ended in 2019. And there was suggestion which was given by different stakeholders that we also need a local amnesty so that businessmen can actually bring their books in order. There's a lot of inquiries have been made, a lot of clarification have been given by KRA, guidelines have been issued, and I must say it is a very good idea initiated by KRA in the sense that if you do your voluntary disclosure this year, then you're going to get 100% waiver of penalty and interest. And I'm seeing a lot of uptake. The only problem I'm having is the pressure that KRA is giving to taxpayers to do it now. And yet I have 3 years to decide when I want to pay or not. It doesn't mean that even if I underpaid my VAT 3 years ago, I've been keeping the money waiting for one day when I'll be able to pay. So there's been a lot of inquiries and uptake on this particular matter, and I'm seeing great positivity on the entire uptake of VTDP this particular year. Remember, in the second year, you'll only be given 50% waiver, and the third year, you'll be given 25%, and you'll be on your own on the fourth year.
The question of the tax appeals, there is a lot of concern, and we know for a fact that Treasury and KRA have gone public that they are working on a strategy around unlocking the potential revenues which are still held up in the appeals process. When you look at that side of an effort to try and unlock tax revenue, how far do you think we can go with this? Because there are cases which, by the confession of Treasury, go back years as far as compliance is concerned.
Remember, if we follow the law, KRA cannot audit more than 5 years. Like we're in 2021, they can only start from 2016 in case they want to do an audit. But there are cases which have been dragging at the TAT level for years. Last year alone, I was able to conclude a case which started in 2015. And of course, it was to the favor of the taxpayer, because the issues were very clear, but we kept on fighting with KRA because it was a huge amount involved. Secondly, they came up with ADR, which was a very good decision. Most of the cases have actually been sorted at ADR level, but there are some which are actually what we can call need legal interpretation, which most of the taxpayers, and especially the big taxpayers, have felt it needed more interpretation of the court, and it's all about legislative and not numbers. So where numbers are concerned, most of the cases have been resolved at TAT level, at ADR level. And now KRA has also come up with IRO. This is independent review of objections. So they are taking good steps to ensure that cases actually end at TAT level and only have a few going to High Court or Court of Appeal. The only problem is I think TAT is overwhelmed. Every KRA case, one or another, one ratio of 1 to 1 goes to objection stage. And the numbers at TAT, the commissioners, is just too few to listen to every case and make judgment. It's not an easy thing, but I think they are trying. The only problem, I think, Treasury and KRA are depending on the figures which are in dispute to thinking that the tax will be collected, which will not happen.
Right, and that point by Samuel takes us to the close of our conversation on Business Redefined. We began by looking at tax and moved into the tax environment. Up next is the Markets Report.